That's the tilt. A slightly weaker set, and we'll come to that in just a minute. But we're joined by Sanjay Sharma, who's the Managing Director at AYE Finance, joining us this afternoon to dissect the numbers. Sanjay, it's a very strong set from a Q1 perspective. Just given the kind of momentum you are seeing in loan growth and AUM growth in Q1, do you believe full year in terms of AUM growth will be much stronger than the 25 to 30% you're guiding? Will you likely outperform that guidance? Because generally Q1 is a seasonally weaker quarter as well. So if this is your weakest quarter, you'll likely pick up pace as the year goes on.
Good afternoon, and thank you, Harsh. You are absolutely right. Quarter one is normally a slower quarter. And I think when we gave guidance for the year, we had at the back of our minds the West Asia war, which was still going on quite aggressively. And also there were news of mortgage being subdued, monsoon being subdued. Now, I think quarter one has in a way moderated both those worries because the war problem seems to be much lower and in terms of effect on the economy. And I think even monsoon, the prediction that IMD says is that we will get a 92% of the long-term average, plus minus 5%. So it's not such a bad situation. And I think, therefore, we are quite optimistic and we can see these growth numbers look better. We had guided for a 25 to 30% growth range. And I think probably after second quarter, we will take a reading again to see if we are going to be on the higher end of the train. But from here, quarter one has been quite robust comparative to how quarter one typically behaves in previous years. So we're quite happy with the outcomes.
Sanjay, before I quiz you on the next one, I want to quickly mark out the Nifty IT. There's been a sharp resurgence and we've entered green where Nifty IT is concerned. That's flashing on the right side of the screen. It'll just come up in a minute for you. But Sanjay, if I were to, again, switch focus back to the margin number, margins have gotten better by 20 basis points this quarter versus last quarter. What's changed? Is it the mix? Is it the loan mix which is aiding you? Is it the cost of funds which is aiding you? Give us some color on that.
Yes, I think it's interesting that the margins have increased because we were projecting a stable or a slight reduction in margin. Now, what's played out is that while the mix, as we move a little of our mix towards mortgage-based micro-LAP loans, we expected the margin to drop. However, this has been compensated by two effects. One is that our borrowing costs have come down. Even our rate of interest on borrowing costs has come down by close to 20 basis points. That's compensated. And also our reversals that happen typically because of NPAs, since our slippages have come down, the reversals are lower. So I think these two have helped move the margins up. Again, it's a positive surprise, and I hope that as the year progresses, we have the benefit of this across the year.
That makes sense. There's also been a bit of a tweak with regard to, so I'll quickly ask you a follow-up on that margin question. And therefore, what's caused this lower cost of borrowing in this quarter? What led to the surprise in terms of the lower borrowing cost?
Harsh, I think after the IPO, which we did in February, we have had a rating upgrade. So while the effect of the rating upgrade is not fully baked into that lowering cost, but I think as we have grown, as our credit costs are looking stable and profitability is picking up, I think we'll continue to see that effect from our lenders that the rates will come down. So I think these are the primary reasons.
That through, Sanjay, I'm trying to understand whether competition is higher and therefore you'd rather prioritize on growth than prioritize on margin accretion?
See, I think we will look at growth because we are very fortunate that we are dominant in this space. There is not too much of competition breathing down our necks, so our margins are quite stable. So for us, it's growth and the management of credit costs, which will be the key markers for this year.
And therefore, will you pass through some of the margins or rather some of the cost of fund advantages that you're getting? Will you pass that through to customers as well? And point number two, How much do you retain? How much do you pass through? This 20 bips came as a positive surprise for you. Any more surprises this year?
See, I think without any doubts, any upside, we would like to pass on to the customer because this business was started to help out the micro scale businesses which were excluded. So I think the thought process is to benefit our customers uh, as we get more profitable. We don't have aspirations to go beyond the guided range of 4 to 5% on ROA. Anything over that will get passed on. And we do hope that, that in the coming year, some of that will start reflecting in our pricing.
Some bit of ROA compression is what we've seen QOQ, even though typically for lenders, you don't look at it QOQ, Sanjay, and I fully understand that. But just given the fact that your margins have gotten better, so there's a 20 bips accretion to profitability there. But despite that, the ROA decline, largely because of OPEX is what I would feel. But is it entirely because of OPEX?
No, actually, Harsh, our OPEX has come down and so has our credit cost. So what's causing this difference in ROA is one-time items. Like, for example, in the last quarter, there was some DA income. This time, we don't have a DA income at all. We tend to keep our DA book very, very small, below 5%. So, but it still causes a swing in our income. So quarter four got the benefit of that. Quarter one that we have seen this time doesn't. That is primarily the reason. Otherwise, the operating ROAs are very similar.
For where does the expansion of ROA come from? Is it just operational efficiency and growth, which will likely continue to play out with credit cost absolute number being flat? Is that where the ROA bump up to 4 and plus will come from?
In fact, you're right, but also the credit costs will come down. In fact, our credit cost in this quarter is down by 28 basis points. And I think we expect it to, today it is 4.01%, we expect it to be between 3.5 to 4%. So this will also add to the ROA.
That's full year is my understanding, Sanjay. So 3.5 to 4 is full year. I mean,
full year, yes.
Marginally above
We'll
it.
exit the year at something lower than that. No, you're right. We'll exit the year at something lower than that.
Yes, yes. So, I mean, I thought of that as a journey and therefore, yeah, that makes a lot of sense. Last off, Sanjay, what's the risk to the ROA guidance of 4% plus for this year? What, in your opinion, is the key risk here?
See, one of the risks was that if monsoon was very, very poor, although we don't do agri lending, we are giving loans to small businesses. What I read was in IMD data was that one is that it is 92 plus minus 5%, which doesn't sound that good, that bad. Second is that most of that effect is going to be in a few states. I think they're talking of South and maybe Central India. We are very spread across the entire country. We are there in 18 states and 3 union territories. So the effect on us will be lower. And therefore, when you talk of risk to the ROA, I think it's the credit risk that we have to manage well. And we have the trajectory to show in the last 4 quarters, we've been reducing the credit costs. I think that would be the only place I would probably focus on to ensure that the ROAs are delivered.
Sorry, just last quick question, Sanjay. With regard to capital adequacy, you're well adequate, and that's because you've done your IPO recently. As you start utilizing that capital, your margins will well come off, right? Because you'll start to utilize borrowings, and therefore interest costs will go up in absolute terms. How should one look at the margin number, therefore?
See, you're right that as we leverage, some of it will show up as cost. The net interest margins, therefore, will see an absolute amount of reduction because of that. But the growth will keep the total revenues up. Our computations show that this year we are on track to deliver a ROA of between 3.5% and 4%. Despite the fact that there is a leverage that is increasing. In fact, leverage, we have always thought of it as a very positive thing because it helps us improve our ROE. So in the first quarter, ROEs don't look very good because the leverage is very low. Leverage will help us. Leverage is a friend, as I see it.
Okay. Sanjay, of course, we'll keep chatting with you, but great perspective on Q1 numbers. Thank you for joining us.
Thank you, Harsh.
All right.